newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris at the JP Morgan Global Markets Conference, and these are your headlines. Donald Trump says India has offered to drop all tariffs on U.S. goods as the deal-making continues on his tour of the Middle East. The pound gets a boost as the UK economy records its best quarter in a year. But the dollar and treasuries face pressure as the billionaire Steve Cohen puts a chance of a U.S. recession at 45%. Plus, Vladimir Putin snubs peace talks with Ukraine as he sends a low-level delegation to the meeting in Turkey. Now, we also have a great lineup of guests joining me here today from Paris, including JP Morgan's head of global market strategy, also the chief data and analytics officer, and then a little bit later on, we'll be speaking to the chairman and chief executive, Jamie Dimon. Also, definitely a buzz here as we're still listening to Emmanuel Macron, the president of France, speaking in the room just behind me. But before we get to news, before we talk about recession risks, let's check your markets as always. Stocks actually falling globally. Again, traders await a speech by the Fed chair, Jay Powell. Also, U.S. economic data coming out later today. Those will give us clues on the sustainability of recent market recovery. The other things that we're watching out for is, of course, signs of a possible recession. That would, that's the main question, see whether equities then push higher or not amid optimism around de-escalating trade tensions with China, but also a bit of optimism regarding this U.S. deals in the Middle East. You can see S&P futures down 0.4%. Let's also take a look at the European market snap. Now, I know there's a bit of relief across the board because we're mostly through earnings season, and that was tough in terms of forward guidance to try and figure out what we saw. Stocks stumbling a bit. Again, maybe that changes with the speech from Jay Powell and the data out of the U.S. Now, President Donald Trump says India has made an offer to drop tariffs on U.S. goods as the Asian nation seeks an agreement on import taxes. Now, Trump was speaking earlier at an event with business leaders in Qatar as part of the Middle East tour. Now, the U.S. president also spoke, or said he spoke, with the Apple chief executive Tim Cook to discourage him from expanding production in India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India.
Well, President Trump also says the U.S. is in serious negotiations with Iran.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
Bloomberg anchor Jumana Bersace joins us now from Abu Dhabi. Jumana, what's the president been saying this morning?
Yeah, well, two bits of market moving information. Let's attack them one by one. First of all, the comments on India, interesting. Obviously, the Trump administration is riding high on the momentum that they had in Geneva this past weekend with that new Geneva mechanism, constructive talks between U.S. and China. Now, President Trump going further and suggesting that India are looking at potentially dropping tariffs on U.S. goods to 0%. So that also would be a major development, not least because earlier in the week, the sounds coming out of the Indian Commerce Ministry suggested that they were looking at imposing higher retaliatory tariffs, i.e. they were taking a more assertive role with the U.S. It seems to have worked. Their strategy has worked. President Trump suggesting now that they're looking at lowering tariffs. And we expect to hear more developments there because the Commerce Minister, the Indian Commerce Minister, is actually making his way to the U.S. for further negotiations later this week. So a positive development on the trade front. But then also take a look at the price of oil. We're down about 3% this morning. President Trump also saying in that Doha press conference that they are potentially getting close to a nuclear deal with Iran. So this is the first time he's articulated that. There have been 4 rounds of discussions between the U.S. and Iran about a nuclear deal. In an interview yesterday, one of the advisors to the Supreme Leader did seem to suggest that they were willing to accept lower enrichment levels of nuclear material, in addition to further inspection from international monitoring agencies as conditions to getting that nuclear deal across the line. So things seem to be moving in the right direction, and that is why you're seeing that reaction in oil prices today.
So, Jumana, what's next on the agenda for the president, but also leaders in the Middle East?
Yeah, so we were just referring to President Trump's press conference in Doha. He's still there now. He's actually headed to the largest military base that the U.S. have in the Middle East. It's called the Udeid Air Base. So he'll be visiting there perhaps in the next 15, 20 minutes, doing a tour. And this on the back of some of the big deals they signed in Doha. Economic cooperation pledge, I should say pledge, not actual deals, worth $1.2 trillion. But in terms of deal value, he's walking away with around $250 billion worth of deals from Qatar, including the largest ever Boeing order from Qatar Airways. This is a record-breaking order valued at around $96 billion per the White House. They say it will create about 150,000 jobs, and obviously is a very positive step for Boeing, the U.S. manufacturer, which has been set back by multiple issues over the last year. So that was a big announcement that came out. And then after that, he will be making his way to where I am right now, Abu Dhabi. And on this side, in the UAE, we are expecting, again, more announcements and also more potential deals inked in the AI space, Francine, because that was one of the breakthroughs that came through from Saudi Arabia, the fact that the Trump administration are open to now sending some of these high-end chips to these GCC countries to help power and fuel their AI ambitions. So we're watching out for that over here in Abu Dhabi.
Jumana, thank you so much. Jumana Bersachi in Abu Dhabi. Now, the International Energy Agency has just released its monthly oil report, saying it expects global oil demand growth to slow for the rest of 2025. Well, I'm now delighted to be joined by Toril Bosoni, head of the oil markets at the IEA. Toril, as always, thank you for joining us, but it's so nice actually to see you in person and do this interview in person. Now, what are the chances of actually an oil glut this year?
Well, we're seeing clear signs that the global economy is slowing and oil demand growth is slowing. We had negative demand growth in China, hardly any growth in India for the past few months and in other Asian countries. So we're expecting oil demand growth for the rest of the year around 700,000 barrels a day. And while supply, as we all know, OPEC has announced that they will increase production, accelerate the unwinding of production cuts. And we're still seeing continued increases from non-OPEC producers, including the United States and Brazil. So the way our market balances are looking right now, we're seeing an oversupplied market for the remainder of this year and extending into 2026.
So, Toril, what happens to the market if OPEC plus does increase by 400,000 like expected on June the 1st? What happens to the oil markets?
So what we're seeing, we do expect the increase to be slightly less than the nominal increase, both in May and in June, because a lot of the countries are already overproducing. That's including Kazakhstan, the United Arab Emirates, Iraq, and also Russia in the latest month. And a lot of some of the other countries are bumping up into a capacity constraint. So we're expecting a slightly lesser increase, but we're already seeing the market pricing in this higher supplies and this oversupplied markets, which is one of the reasons we see oil prices falling about $14, $15 over April and into May before recovering somewhat. And we're seeing other producers reacting, responding to the lower prices, in particular in the United States. The earnings season this year, the financial reports, we're seeing a lot of the independent producers cutting their spending plans for the year, laying down rigs. So we're expecting lesser growth in the United States in response.
But, I mean, I think there's something about, like, OPEC could actually increase production by 400,000 or a little bit less, but thereabouts until October. I mean, that's not priced in the markets right now.
Yeah, so we're seeing, I think the market is expecting the increases, is particular from Saudi Arabia. The biggest increase will come from Saudi Arabia. But of course, the market is also looking what's happening in Iran and Venezuela. We're seeing the United States putting increased sanctions on those countries. And while negotiations were underway in Oman for a nuclear deal, there's a lot of uncertainty what will happen to Iranian supplies. Latest month, for April, we did see Iranian exports continuing at relatively strong rates of about 1.6 million barrels a day. But we are seeing China taking less of that. So it's a question if we will have a significant supply loss with the new sanctions that are being put on regularly now over the past few weeks.
But so if Trump does reach a deal with Iran, how much idle capacity comes back online?
So it's a question. We're seeing now Iranian production about 3.4 million barrels a day in April. We think their capacity can be slightly higher, 3.7, 3.8. So there could be more a few 100,000 barrels a day of supply to come. The question is more if sanctions are lifted, if there will be other buyers other than China that comes into the market. So, and alternatively, if sanctions are really new Chinese independent refiners and ports have been put on the sanctions list now. So if that pressure is maintained or even increased, we can see lower exports from Iran. So there's a lot of uncertainty there, depending on the deals that are being made and negotiated at the moment.
So, Toril, for the moment, it feels like it's quite difficult actually to price a U.S.-China kind of normalization. But if prices stay low, does it kill off growth from U.S. shale?
We have reduced our U.S. shale forecast for the second month in a row this month due to the lower prices. And as I said, it's the U.S. producers already announcing cuts up to 9-10% in their capex spending from what they had planned earlier in the year. So we have cut our shale forecast by about 200,000 barrels a day for 2026. The biggest impact will come next year, not this year. So we do expect growth this year. Next year, we may see a decline in shale for the first time since 2020. And this is in response not just to higher OPEC supplies, but also to the weaker economic outlook and lower oil demand growth expectation as a whole.
Toril, thank you so much. As always, Toril Bosoni there from the International Energy Agency. Now, you can hear the crowds actually leaving that Macron speech here at the JP Morgan Capital Markets Forum. And so the loudness, and actually there's really a buzz here as they talk about the global economy and possibility of recessions. Now, trade chiefs from some of the world's biggest economies are competing for access to U.S. Trade Representative Jameson Greer as they look to advance negotiations with Washington at a gathering in South Korea. Our Chief North Asia correspondent, Stephen Engel, is there for us at the APEC meeting in the island of Jeju. Stephen, thank you for joining us. It's less than a week after Jameson Greer helped the U.S. and China agree on a temporary cut in tariffs. Are other countries now hoping for a similar deal?
Yeah, that's absolutely right. And that's why we're here as well. We were here early this morning. It's all obviously into the evening now. And Jameson Greer, the U.S. Trade Representative, was the first of the major officials that we saw come in here. He said he wasn't doing media right now. But again, he's here for 2 days. He still might sum up what he talked about and who he talked about after tomorrow's closing of the trade ministers gathering here on Jeju Island in South Korea for the APEC 21 member economies. And what we do know is he has already met with the South Korean trade minister. Obviously, South Korea and the United States are working at a possible trade deal of their own. But also, we've heard he's met with Lee Chang-gang, who is the Vice Minister of Commerce for China. He is essentially the trade representative, the counterpart to Jameson Greer, whom he met in Geneva. And the two of them across the table, along with Scott Bessent and He Lifeng of China, came together with that trade truce for 90 days, obviously. So for those two gentlemen to meet and have a talk within about 5 days of each other is a positive sign. We don't know the exact details of their conversation behind closed doors here at the International Convention Center of Jeju, but the fact that they met again to perhaps flesh out further agreements is a positive sign.
It certainly is, Stephen. Thanks so much, Stephen Engel there in Jeju in South Korea. Now, coming up, we'll be joined by JP Morgan's head of global market strategy for an exclusive conversation on where he thinks markets are heading. That's next, and this is Bloomberg. Welcome back, everyone. Now, the French President, Emmanuel Macron, says there's no longer a level playing field between the EU and the rest of the world. Now, Macron also says the relationship with the UK must be totally reinvented. He's been here speaking at the JP Morgan event in Paris. Well, JP Morgan was the first big US bank to expand a presence in France after Brexit, and Macron met with the chief executive, Jamie Dimon, earlier. Now, we're now joined by Dubravko, Lakos-Bujas, head of global market strategy at JP Morgan. Thank you, Dubravko, for being here with us. Congratulations on another successful global markets conference. I mean, if you're in global markets, I don't know how your heart is holding holding up? Because there's been quite a lot of volatility. Has it been good volatility for JP Morgan or not so good?
So first of all, thank you for having me. I think volatility has been manageable, and I think along the way it's created a lot of opportunity. We've seen a ton of dispersion, especially beneath the market, and I think that in itself sort of creates a lot of opportunity. Obviously, you just have to be very smart about it. Focus very much on risk management because things keep being thrown at you from like left and right.
Yeah, and they change very fast. So have you had to change some of your systems on what to look at?
Yes, I mean, I think there's one thing that we're sort of learning along the way is you sort of have to keep a pretty open mind. You have to stay very nimble. I think forecasting beyond sort of like a month or 2 or 3 is really hard. So, one of the things that we've been sort of focused quite heavily on is just kind of scenario analysis and thinking about different types of scenarios that sort of play out if certain things sort of crystallize or not, and then sort of try to position and sort of put out views along those lines.
What do you think we know? And I mean, it feels like there's a lot we don't know, but are there certainties that you see in the markets?
So I do think that there's definitely more clarity than than sort of say a few weeks ago. I would say high level, the left tail of the distribution, I'm going to keep it pretty big here, has definitely been truncated and cut. And the distribution of outcomes were extremely wide several weeks ago, and I think that's been narrowing as some of the sort of uncertainty around trade, tariffs, policy sort of started to get reined in. I would probably say there's a good chance that the detox period that the U.S. administration has been talking about to a large extent is behind us. I don't think we're fully out of the woods yet, but the focus is now very much so turning towards tax cuts, which has been high on the president's agenda. Deregulation is still there. And so we need to see how things play out there because the fiscal backdrop still remains a very sensitive backdrop in the U.S. And you never know. You could have sort of surprises and risks, especially on the bond side.
Yeah, I mean, I was going to say, actually, I mean, treasuries were behaving sometimes, there were a lot of question marks on how they were behaving, on what they were behaving as. And then there were a couple of, bond auctions that you weren't sure who was buying because one didn't go so well and then the other one went quite well. How do you treat treasuries right now?
So I think it's hard to have a lot of conviction. I think it's hard to deploy a lot of conviction on the rate on the bond side. Look, the move up in rates recently has been relatively quick and abrupt. Fed expectations have gotten reversed. We've sort of pushed out our view around future Fed easing to basically back end of this year, starting in December. But again,
so one cut.
4 times, but starting in December, and then sort of going into 2026, keeping in mind that Chair Powell mandate ends sort of halfway through next year. So I think you really need to pay close attention to how the fiscal backdrop evolves, how the deficit discussion evolves, what the House, the Senate end up doing on the tax side along with the president, because you could have the bond vigilantes trade sort of back in the game. 10 years sort of back to 4.5, 4.6. We're not that far from 5. And if you sort of start going back to 5, that could start creating, again, issues for various parts of risky markets. And risky markets, whether it's equities or credit, it's enjoyed a very, very strong sort of comeback over the last few weeks. So that's something that we're paying very close attention to.
Would you worry more about credit than equities?
I would not worry. I would worry more about equities than credit. I would sort of make a case that credit probably remains sort of the superior asset class here with the most attractive risk reward. We as a bank, as a research department, remain generally positive on the credit side, especially in the U.S., where I think a lot of the things continue to go in the right way for the asset class. And frankly, if you envision a scenario of, let's say, no recession, we're able to dodge a recession, but the growth backdrop remains challenged, sort of sub-trend, I think that's one of the perhaps best environments actually for credit, especially areas like high grade.
Are we able to dodge a recession? I think still Steve Cohen this morning had it like 45% probability. That's pretty high.
It is pretty high. I would probably throw my own view at about 35%. Our economists might be a little bit higher. Stock market might be flying something a bit lower. So I would say it's below 50, and I think it's definitely sort of come down. I think we can probably dodge it. Our forecasts call for a negative growth quarter in the back half, third quarter, but then fourth quarter we believe things again resume on the positive side. In 2026, probably will be able to eke out some growth. So we're not out of the woods, but we think the left tail again has gotten cut a lot, and most likely recession, we should be able to dodge one.
Any opportunities in Europe?
Well, I think it's a tough one. I think Europe has a ton of upside potential, but I think a lot of homework needs to be done. I think a lot of it depends on execution. President Macron just basically talked about that. Revisions to things like capital formation, I think, is very important when you sort of think about innovation prospects, growth prospects, and making Europe more competitive on a global landscape and versus a heavyweight like the U.S. So I'm hopeful as a European, but a lot of homework needs to be done. I would say sort of aerospace defense. It is a bit consensus, but I definitely think there's still a lot of upside there. These are secular themes, and a lot of these companies could become a lot bigger in size. And then I think there's definitely a question mark around areas like luxury, which historically has been hot. I would say not all of luxury, because some things are pretty expensive at this point. But that's the way I would go about it.
I know we have a lot of questions from viewers, for example, on German bonds, right? Because of defense spending, but the chancellor seems weakened. Again, when you look at FX and bonds in Europe, is there anything that looks attractive?
Well, we think that there is still upside in terms of downside for dollar, upside for the euro. Not a lot, maybe. Our convictions are not as high as they were, but generally still, I would say, an upside trade. I think as far as Germany had sort of these debt breaks on. Now they're sort of being released. We're talking more about a fiscal, thrust kicking in, both in terms of defense as well as in terms of infrastructure. We need to see how much of that stays in Europe in terms of the multiplier. But I do think that the German bond market, in terms of supply, actually looks quite attractive, and maybe in some cases more attractive than sort of the U.S. side. And I think the demand should be there, right? So I'm not really that worried about that.
This is, one of the questions is, U.S. supremacy. What happens to dollar as a reserve currency? Could this be the time for European leaders? I know, Emmanuel Macron at your conference was a little bit downbeat, but could this be the time for Europeans to take it seriously and try to push Europe?
Yes, I do think the opportunity set is definitely much bigger than previously, because a lot of what used to be headwinds facing Europe, I think there's a case to be made that they're turning into more of a, call it tailwind or semi-tailwind. The potential is definitely there. I still think the dollar remains a reserve currency to a large extent. U.S. exceptionalism got sort of hit a bit along the way, but I think we're going from sort of this hyper-exceptionalism to still relatively strong exceptionalism. The U.S. brand got hit, but I still think remains intact. So I think the opportunity set still remains quite strong on the U.S. asset side, so I would not dismiss it. And the one thing we haven't talked about, frankly, is AI. I think AI theme remains a power theme, and Europe, unfortunately, I don't think has a very strong footprint there. I think there's potential for Europe to invest more. But it's really, I think, down to the U.S. and China. And U.S., I will say, just from a global perspective, does have a pretty strong first mover advantage, just in terms of how much money and capital has been thrown into the sort of AI complex, including on the private side.
It's interesting. I'm glad you brought up AI, because there does seem, because of the trade wars between the U.S. and China, the AI story is being looked at the markets, but maybe not looked as it was 4 months ago. Is there a danger that the market just focuses on one thing and misses sometimes the bigger picture, the bigger trends?
I think it is. I frankly think AI and sort of technological disruption sits at basically the center of just about everything, right? And so I think that's going to continue to create a lot of dispersion. You're going to have winners, losers, and so I think it's really important to sort of pay attention to this theme and see how it basically intersects with basically all kinds of sectors, because it's touching everything. It's touching not just sort of the broader technology complex, infrastructure, it's touching healthcare, it's touching the consumer space. So it's touching all different fronts. Industrials. I think that's the elephant in the room here.
Dubravko, thank you so much for joining us. That was Dubravko Lakos-Bujas, head of global market strategy at JP Morgan. Now, coming up, Donald Trump's efforts to secure peace in Ukraine hit a roadblock as President Putin snubs talks in Turkey. We'll have the details next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, the JP Morgan Global Markets Conference in Paris. Now, Donald Trump says India has offered to drop all tariffs on U.S. goods as the deal-making continues on his tour of the Middle East. The French President Emmanuel Macron tells the JP Morgan Global Markets Conference here in Paris that European Union must revamp its alliance with the UK. Plus, Vladimir Putin snubs peace talks with Ukraine as he sends a low-level delegation to the meeting in Turkey. Now, the Russian President Vladimir Putin has named a group of low-level officials for peace talks with Ukraine and Turkey, giving no indication that he plans to join negotiations. Now, this comes as top NATO diplomats are meeting elsewhere in Turkey, where the Secretary General Mark Rutte has said the ball is firmly in Russia's court.
Ukraine is ready to commit to a ceasefire and immediate negotiations. That's absolutely clear. The ball is now clearly in Russia's court. They have to explain what they are doing, why they are here or not, and with what team or whatever. But let's make sure that we all understand that the ball is in their court. Ukraine is wanting to start the negotiations as soon as possible. And as I said before, it is thanks to the Americans and President Trump that the deadlock has been broken.
More on that NATO meeting shortly, where Bloomberg's Piotr Skolimovsky is standing by. But first, let's bring Greg Sullivan, Bloomberg Russia economic and government editor. Greg, hi. So Putin waited until very late to name his delegation. What do we know about them, and what does it tell us about, what's going on?
Well, that's right. Speculation had been building that President Putin could actually attend these talks, these direct talks that he had actually proposed last weekend. However, late last night, the Kremlin did name the delegation. As you said, it was a very low-level delegation. Likely, these are not people that are empowered to make decisions. So that's likely to tamp down any expectations for a major breakthrough. In a lot of ways, it's signaling a very slow and cautious approach to any kind of negotiations with the Ukrainian side. But there's still a lot that we do not know about these negotiations, including who from the Ukrainian side will attend, when these negotiations will happen, and including what format they'll take place, whether it will be direct engagement between the two sides. So a lot of questions remain, even as we know that it's a relatively low-level delegation with few hopes for a major breakthrough from the Russian side.
So, Greg, what is Putin looking for in these talks?
Well, one thing that's interesting about the delegation that he named, it's being headed by someone named Vladimir Medinsky. It's a delegation that largely reflects the same delegation that went to earlier talks in Istanbul after the start of the war in 2022. Those talks obviously fell through, but they could signal that Putin is looking to restart negotiations where they left off. Throughout this process, Putin has really stuck to maximalist demands. He sees himself making slow but very costly battlefield gains, having the military advantage. So he's largely stuck to very tough demands that Ukraine is unlikely to accept, or that will be very hard for Ukraine to accept. So that's one possible thing. Another thing that we should be looking for is a very technical engagement that could lead to some sort of future engagement, including possibly Putin joining negotiations down the road.
Thank you so much, Greg Sullivan there. Now, Piotr, the uncertainty over these peace talks dominating, of course, the NATO meeting today.
Indeed. So NATO foreign ministers are meeting here in Antalya in Turkey, also in Turkey, for an informal meeting, which is sort of a preparatory one for this summit. It will happen in Hague next month. And obviously the question of whether those talks between Putin, Zelensky, and whether there are going to be talks between Russia and Ukraine in Turkey as well, they were dominating the discussions as we went into the meeting. Generally, foreign ministers from NATO countries criticized Putin for not showing up. They pointed out, to what they called an empty chair in front of Zelensky, who is going to come and he's ready to get involved. At the same time, the main topic for the discussion here is that Trump has called on NATO allies to spend 5%, to raise their defense spending to 5% of GDP. This is the goal that's very ambitious. Even the U.S. doesn't meet that goal. And they're here to discuss how to achieve that. So there's clearly the willingness. We also heard from Foreign Minister of Germany a very, very strong statement saying they will follow the U.S. So they're obviously very much in line and very much in condemnation of where Russia is on those talks and ready to play ball when it comes to more defense spending that the U.S. is demanding.
Piotr, thank you so much. Piotr Skolimowski there from the very latest on this NATO meeting. Now, Boeing has landed its biggest ever aircraft order, with Qatar Airways agreeing to buying up to 210 wide-body planes. And the deal was signed during Donald Trump's visit to Doha. The White House says it's worth $96 billion. Now, for more, let's bring in Bloomberg's Benny Camel, who leads our global aviation coverage. Benny, good morning. So how did politics and business actually intertwine on this deal? Are we seeing aircraft diplomacy on display and at its finest?
Yes, absolutely. So this has been a trip of dizzying numbers. He started it off in Saudi Arabia, and then yesterday, Doha. That's where the big Boeing deal was announced. We'd been hearing about it for a while, but in the end, it ended up being even larger than we expected. So it's all told 210 aircraft. That includes firm deals and options. So if they were to throw in the options and actually turn those into firm deals, that would be 210 aircraft, almost 100 billion in terms of value. So this is obviously a huge number, much to Trump's liking. He likes to throw around these big numbers and the kind of deals that he throws in. And for him, as you said, it's been very much sort of the blend of politics and economics, sort of economic statecraft, if you will. And planes have featured very heavily in that. We had a small deal in Saudi Arabia. We had some military deals. And then we had the big one yesterday. And the one that's still kind of looming, the slightly curious one, is what will happen to the Air Force One jet that Qatar is allegedly considering as a gift. We have no clarity on that yet. But again, that was sort of one of the stranger episodes and also had to do with planes, which are very much something that Trump cares very deeply about. He's a big plane buff. So this was very much sort of a blend of all things that he cares about.
Yeah, so Benny, where does this leave Airbus and its own aspirations for a deal?
Well, at the moment, it looks a bit like a winner-takes-it-all kind of deal. You have this blowout accord with Boeing. Obviously, very happy faces on that side. Will Airbus be able to come back? That's the big question. They might do so at the Paris Air Show. That happens next month. That's typically a forum where Airbus can shine. So maybe Qatar, they are a big buyer of Airbus planes. They might come back. They fly the A350 aircraft. They fly the smaller A330 aircraft. So they could come back. But it's unlikely that you'll see these kinds of numbers coming out of Airbus as well. So in this case, this is very much Qatar throwing its weight behind Boeing, and that's why it's such a decisive win for the US manufacturer.
Benny, thank you so much. Bloomberg's head of global aviation, Benedict Camel. Now, JP Morgan has been ramping up its use of artificial intelligence along with other U.S. banks. That's as technology transforms the way millions of people, as you and I, do their job. Now, joining us now is Teresa Heitsenrether, the Chief Data and Analytics Officer at JP Morgan. Teresa, thank you so much for joining us. I mean, you're really at the forefront of one of the things that's probably most transformative and exciting. What surprised you the most since you took this job?
So we think that AI has the potential to really deliver amazing scale and efficiency as well as client benefit. So it's a real priority for us. And we've been very focused on this for a long time. We've used traditional AI and machine learning in areas like fraud detection and risk management and marketing. But the big surprise has really come with generative AI, which really opens up new possibilities for us. We, I think, were one of the first in the industry to really roll out Gen AI to the majority of our employees. So we have 200,000 people who use this now as part of their everyday work.
What does this look like? So do I ask a question that can help me do my job on a day-to-day? And this is proprietary JP Morgan things.
We've set it up in such a way that you can use the benefit of the models with JP Morgan data. So that's really where the value comes from. We think data is what differentiates us. And so people are finding ways, whether it's lawyers looking at contracts or bankers preparing presentations for clients, what it's doing is really freeing up time and capacity. On average, we're seeing people gaining an hour to 2 hours of productivity a week, which is really quite significant. And we're really still in the early stages.
I mean, it feels like, so you have an added support, right? It's like an extra assistant.
It's like having your own personal assistant, exactly.
Teresa, how does that change, hiring plans in the future? So without actually talking about job losses, will it lead to less hiring?
So at the moment, we're still in the very early stages of the technology, so it hasn't had any material impact on workforce or hiring. Over time, there is the potential that there'll be some job dislocation, but we really think that this is a tool that just makes people more productive. So we should be able to grow and do more with less investment, and that's really where we see the value. In the long run, ours is a business that's based on trust and relationships, so people and having the great talent is always going to be a priority.
Is it difficult to put a number on that productivity or on job losses in the banking sector as a whole?
I think it's really still early at this point. I think that we will see significant productivity gains, and the question is, does that open up the opportunity to just expand and grow and do new things? I think a lot of that capacity will get absorbed in growth.
Teresa, what does that mean for your models in markets, for example? Does it change how you see risk and things like that?
So we've always used AI and algorithmic analytics in our trading businesses for pricing and hedging. I think what's changed is now we can bring Gen AI to supplement that as well. And that's allowing us to really give our sales and trading teams better, quicker information because we can synthesize news and social media. We're also working on behalf of clients to let them have interfaces that allow them to look at the great wealth of JP Morgan research and get insights much more quickly.
So again, what does that look like? Is it words, for example, the number of words used? I know when I started news, actually, that was one of my first jobs, is counting the number of words that, Fed president or the Fed governor.
We can look at Fed minutes and analyze them very quickly now and look for themes in the news and associate. Gen AI can look at data across different modalities, and just the ability to synthesize and aggregate information to drive insights is really very innovative.
I know there are a number of central banks that are looking, for example, at potential regulating or that have worries. The Bank of England launched a paper a couple of weeks ago on AI in banks. How do you look at regulation or trying to make sure that you have a good handle on it?
Yeah, we've been very actively engaged with regulators around the globe, and we think we have an important part to play in helping them formulate safe AI policy for financial services. I think where our industry is very different than others is that we have a great prudential framework that protects market integrity and end investors, and the same is true in AI for trading. I think there are very well-established rules, and I think we'll continue to see the same outcome-based regulation take effect here as well.
Teresa, coming back to actually JP Morgan employees, how do you teach them how to use AI? I know your chief executive has said, look, AI will never fully replace humans,
right?
But I guess our skills will have to significantly change as AI increase.
We agree that the skills will likely change over time, and that's why we've been so focused on putting the technology in people's hands. There's no better training than actually using it, and we've introduced a lot of training. We want people to develop those skills to be effective as AI becomes even more and more embedded in the way we work.
Thank you so much for joining us.
Thank you.
That is, of course, Teresa Heitsenrether, the Chief Data and Analytics Officer at JP Morgan. Now, coming up, can Alibaba keep up the momentum for Chinese tech when it reports earnings later? We'll have a preview next. This is Bloomberg.
We don't have the same exodus symptom in Europe in any way whatsoever. So the reality is that European companies continue to list in Europe. London-based companies continue to weigh their options. I can tell you that among the few companies that were waiting 6 months ago or 1 year ago, prospects of being listed in Europe versus the US, I had dialogues with all of them. They are fundamentally revisiting the US options because the level of uncertainty over there.
That's the Euronext chief executive speaking to Bloomberg a little bit earlier. Now, Chinese tech companies are enjoying a good week. Solid earnings from Tencent and JD have added to the momentum from a U.S.-China trade thaw. Now, it's now up to Alibaba to keep the rally going as it reports results today. Well, Bloomberg's Tom McKenzie joins us with a preview. Tom, so good to see you. Alibaba has had a stellar year. What can we actually expect from earnings?
Yeah, Fran, the stock is up 56% year to date, despite, of course, all the concern in April about the impact on tariffs. And Alibaba is, of course, that touch point on the Chinese consumer. It is the largest e-commerce company, of course, there. But also it's a touch point on the question of the innovation around AI and how effectively they're rolling out products on that front, and how effectively they're actually integrating AI into their own businesses. And then, of course, they are also a touch point on the impact on trade and tariffs, to what extent they're absorbing some of that increase in tariffs, even after, of course, that easing of tensions over the weekend. Top line, we're expecting net income for the most recent quarter to come in at $3 billion, around $3 billion, on revenue of about $33 billion US, which would put Alibaba on a good footing. And as you say, Tencent coming out with that beat in the week, JD.com's CEO as well, saying that they're starting to see an improvement amongst Chinese consumers, some optimism from JD.com with their revenues up about 16%. So on all those touch points, Alibaba is interesting. I think the cloud division is going to be particularly in focus, as is the logistics business. On cloud, it's going to be about AI and how much demand they're getting from their enterprise customers.
So can it actually sustain, Tom, the AI frenzy?
Well, what they're able to do and have effectively done is continue to iterate around the models that they're pushing out as they try and compete with DeepSeek in the Chinese market and others in terms of the large language models that are being produced and the labs that exist now in China. And they're keeping up in terms of that competition. They continue to iterate. In fact, they came out with 2 changes to one model, 2 upgrades in just a single month. And then the question is, to what extent can they drive margin gains, again, as they create those efficiencies, better targeted advertising, better connections between their merchants on their platforms and the end buyer as well. So those are all the kind of details that we were looking for around the AI push. But Alibaba is front and center, certainly, in terms of China's broader ambitions to be a leader when it comes to AI products and innovation on that front. So details and what executives have to say as well, given that Joe Tsai, one of their team, near the head of the board, of course, on the board, has suggested that he's started to see a slowdown and maybe there's a bit of a bubble in terms of that data center demand. So what we hear from executives, as well as the details that come out on terms of their investments around AI, how much capex they're putting to play there, and the demand they're seeing from their customers.
Tom, thanks so much. Tom McKenzie there with the very latest, of course, on some of these tech companies. Now, Siemens has reported a jump in revenue and profit, driven by a recovery in factory automation sales in China. Now, the German manufacturer also confirmed guidance that revenue this year could grow as much as 7%. Now, the chief executive, Roland Busch, has been speaking to Bloomberg's Oliver Cook.
The tariffs this is not stable, as you know. They change from one day to the other, and based on what we know, we obviously dive very deep into understand what the impact on our numbers would be, and the conclusion is here very limited. And here comes the reason. Number one is we have a very, very strong manufacturing all over the world, also in China, in the United States and China. In the United States, we have 80% of local for local value. Then we have measures in place. So in some cases, we're also pushing higher costs through to our customers. We increase the prices as our competitors do as well. In some cases, we have even contracts which allow higher commodity prices to go through to the prices. We work on our cost savings as well. So all in all, the impact on Siemens so far is limited. The largest impact is eventually by Siemens Healthineers, as I explained. And this is a reason why we kept the guidance. There are secondary effects, for example, that the supplier of our suppliers might increase the prices, and that comes to us. Hard to say, we cannot calculate it yet. And of course, if there's higher inflation in the United States and the growth rate would go down, would be an impact too. We took that all into consideration and came to the conclusion that we can keep our guidance as it is so far.
And also looking into the future, because one of the sort of main objectives of the tariffs and the Trump administration is to bring a lot of manufacturing jobs back to the United States, building new factories, updating factories. There has been some skepticism about some of the announcement in terms of how real those sort of deliveries are going to be. You in your digital industries business, this is factory automation. Are you seeing any evidence of a surge in sort of desires? Have you been having conversations with manufacturers who are trying to expand their footprint within the United States? Are you seeing any evidence of that happening?
So not yet is the short answer. Of course, we see some momentum in, for example, semiconductor industries, which are many projects and they're in place and they're ramping up. But if it comes to really manufacturing of any kind of parts for automotive and the like, we don't see it yet. Reason is that the uncertainty on where these tariffs are finally ending is so high that people say, let's wait and see before we invest. Number one. Number two is if manufacturing comes back, we strongly believe it will be highly automated. There are limited trained labor available in the United States market, and that will not change going forward. So what would you do? You would automate and digitalize as much as you can. And this is where Siemens comes into play. We have a very, very strong portfolio, also for the United States, supercharged now with AI technology. We can simulate everything, the products, the plant, before you build it, and really drive it in a digital twin way in order to optimize productivity, save costs, but also working with less labor. So therefore, we believe there will be an inflow of more investment in the United States. By the way, Siemens, we invested too. We recently opened a plant in Fort Worth, in Texas, for data centers for electrification. So we see more coming, but it's too early to say, but it will come.
And moving from the United States to China, the last time we spoke, you started to see a few bright spots within the Chinese economy. What are you seeing in China?
So if you talk the automotive industry, this is really muted, if not China. China is really picking up momentum in automotive industry. We see that, and this pulls a lot of also machine building, machine tools, automation. So there's also private consumption is gradually starting. As I said before, it will not be a step up, a steep step up, but a gradually step up, and we see that China is picking up momentum.
The Siemens CEO there, Roland, Busch, speaking to Bloomberg's Oliver Crook. Now, Walmart reports earnings today with analysts and investors focusing on how the world's largest retailer is responding to global trade tensions. Now, let's get more from Bloomberg's Charlie Wells. Charlie, it's our daily wrap-up for retail. What do you have?
That's exactly right, Francine. Now, we are counting down to these earnings because Walmart is such a bellwether for broader consumer sentiment. We can see that Walmart has been outperforming the S&P 500 this year, and Walmart tends to perform better in periods of uncertainty because consumers really razor in on price. That is something that Walmart is well known for, but we're looking out for any surprises here at Walmart. There are expectations that same-store sales at Walmart could trend down in the quarter, so we're looking out for that, but we're also focusing in on the impact of trade here. That really is what analysts and investors want to know about. We got a little bit of a sneak peek at Walmart's Investor Day last month with their CFO talking about their import mix, talking about how about a third of the products that Walmart sells in the United States are imported. Their key sourcing comes from China and comes from Mexico. We know that for this quarter, at least for a while, those 145% tariffs were in effect. So that is an issue that we're going to want to unpack here. And on that call later today, we may hear analysts talk about shortages. That is a topic that has certainly been in the air. We know, based on external reporting, that executives at Walmart and other big box stores talked to the White House about this issue of shortages. That is unlikely to be addressed publicly. But when you look at the traffic into the Port of Los Angeles, such an important port of call for goods from China, you see that traffic dropping significantly. So that could speak to some issues there. But another question that we're really likely to hear later today is how Walmart, where price is so important in the context of these tariffs, do they plan to pass on price hikes to the consumer or eat into their own margins?
Charlie, thanks so much. Charlie Wells there with the very latest on some of the shipping and, of course, retail concerns. Now, there's plenty more to come here from the JP Morgan conference in Paris, including an exclusive interview with the chief executive, Jamie Dimon. That's at 1 p.m. London time. We leave you with these live pictures in Qatar of the Al Udeid Air Base, the largest U.S. military installation in the region. We believe the president could address the crowd shortly. This is Bloomberg.